Welcome to the Real Vision Daily Briefing. It's Monday, July 19, 2021. I'm Ash Bennington, joined today by Jack Farley and our guest, Darius Dale. Obviously, today is a difficult day in global equity markets, in U.S. equity markets, especially. Dow Jones Industrial Average, the big loser on the day, off over 2%, 2.09%, settling down at 33,963. The S&P 500 off more than 1.5, down 1.58%, off, settling at 4,258. Jack, what are you looking at?
Well, Ash, as investors fled risk assets worldwide, they piled into the safe haven asset, that being the U.S. Treasury market, with the U.S. 10-year Treasury yield dropping 11 basis points from 1.29 now down to 1.18, which is the lowest level we've seen since February. Ash, what else is on your radar?
Yeah, I'm also looking at energy, particularly the oil markets here. It's pretty ugly. WTI crude NYMEX off 8% on the day, more than 8%, settling down at 65.97. Brent off almost 7.5%, settling at 68.11. Not a pleasant day on the energy markets. Kind of a miserable day in equities. Fortunately, we have Darius Dale here with us today to give us the big picture, to bring some context to what we just saw in the capital markets, in commodities. Darius, how do you contextualize this in the big picture?
Yeah, Ash, I would say the probability of the market regime transitioning to deflation just went up a lot today. Obviously, it's pretty clear to see that on the tape, but in terms of how we scored at 42 macro through the lens of our global macro risk matrix, we're about as tight towards tilting to deflation as we possibly can be. In fact, all it's going to take is one more signal across those 42 indicators to actually break in a way that actually would amplify deflation's probability to put that on.
And Darius, you're transitioning right now from a Goldilocks view into a deflationary view. What are the key indicators that you're looking at? What is the place where you see the strongest intent on this transition? In other words, where do you see the strongest indicators that this is happening right now?
Yeah, no, that's a great thing. So in terms of what happened today, we run this thing called our volatility adjusted momentum signal, which we're scoring price momentum relative to the regime of volatility to identify probable drawdown risk, probable breakout risk, things of that nature. So in terms of what happened today, we saw the DAX, the Euro Stock 600, and WTI break down to neutral from the perspective of our volatility adjusted momentum signals from bullish. We also had bearish VAMS breakdowns today. VAMS is short for that, or that's short for volatility adjusted momentum signal. The Bloomberg Commodity Index, the Euro, the British Pound. So those are that's sort of the epicenter of what's happening today. In terms of what I'm looking at for incremental signals, I would start by just focusing on WTI. If we go below 66, we're at 66.30 right now. If we break down below 66 and hold below 66, that would actually catalyze a bearish VAMS breakdown. So keep that 66 number in your head. It's no surprise that we're closing right around there because that's the signal line I think market participants are really worried about. I would also highlight the Deutsche Bank Currency Volatility Index, CVIX, on your Bloomberg terminals. If we see a breakout above 640 on that, it's likely to catalyze a bullish breakout of the U.S. dollar that would actually catalyze further bearish breakdowns across other commodity markets. And then lastly, high yield OAS. This is something I haven't seen a lot of people talk about, but OAS is short for option adjusted spreads. So it's the ratio or the spread of what you get when you own a junk bond relative to a U.S. Treasury on an option adjusted basis, a call option adjusted basis. And that level of 335 has already been breached. We're tracking around 340, 345 this morning. If we stay above that, we're likely to see a bearish breakout in high yield credit spreads, bearish breakdowns in high yield credit prices.
Darius, let me ask you one more big picture question. I know you've explained it before on Real Vision in other places, but tell us a little bit more about the way VAMS works. How do you volatility adjust these market signals, and why is it significant in the way that you view indicators?
Yeah, that's an outstanding question, Ash. So I'm from the Mandelbach School of Risk Management. I do believe, as he proved with his empirics, that volatility is often a leading indicator for price, particularly for big changes in price momentum. And so, obviously it's pretty easy to calculate price momentum. There's a million different ways to do it. Exponential moving averages, simple moving averages, moving average convergence. That's the easy stuff. How we actually overlay the volatility adjustment factor is we're actually looking at where volatility is relative to its distribution. If you break volatility into two medians, any time series of volatility, one side of the median for the asset, depending on if it's positively or negatively correlated with the asset, will likely produce higher levels of drawdown risk in the asset. And so what we're trying to do is identify where in the local volatility regime do we cross over into that quantile that suggests there's higher drawdown risk for that particular asset. So when you see both volatility on the wrong side of the distribution and you see price starting to break down, that's what we call a bearish FAMS breakdown. And we're starting to accumulate those.
Yeah.
So Darius, with the VIX now at above 20, how does that impact your model?
Yeah, no, the VIX would have to get above 27, or right around 27, to catalyze a bullish breakout in the equity volatility for that particular indicator. We've seen so volatility and credit spreads broadly were bullish as recently as a few weeks ago. They actually a couple of weeks ago really started to break to neutral. So moving from bearish to neutral is a positive delta. And then I think, as I highlighted with the credit spreads and obviously highlighted with the VIX level just now, we're obviously moving to levels that would start to catalyze broader risk-off signals. So, I spoke about this in my Around the Horn Weekly publication on Saturday. Hey, this is going to be a very important week because we talked about this last time, or for at least a couple weeks now. Deflation, when you think about the four different market regimes: Goldilocks, reflation, some people call it stagflation, we call it inflation, and then lastly deflation. Deflation among those four regimes, deflation has historically been the fastest to capture what we call the modal outcome title and actually become the dominant market regime that investors are risk managing on a trending basis. So knowing that, we understood that, hey, we're dangerously close in terms of the neutrality that we're observing across the models that would suggest to say, hey, this week could be very, very important in terms of investors finally pricing in deflation at the margin and actually having to make that full portfolio construction pivot.
Hey, Jack, we said it at exactly the same time. I was about to throw to you to ask about the VIX. VIX right now at 22.49, off the day's highs, but still up considerably, about 20+% on the day. What are you thinking about what's happening in VIX, Jack, and how is it informing your view of the other things you're looking at in these markets?
Well, let's see. So the VIX is the about 30-day implied volatility for options that you would get via what's called a variance swap. So the thought is when it increases, people are paying more for protection on the downside as well as for upside gains on the upside.
This is on the S. This is on. We should point out this is on the S&P 500.
Correct. So when we went into the crash in late February, early March, the VIX reached a high of somewhere in the 80s, I believe, with the high being on March 23rd, the day that Jerome Powell announced his decision to buy individual bonds. Actually, I think it was March 18th. The March 23rd was the low for the S&P 500. Excuse me. But Ash, to be honest, I haven't done a ton of work exploring the relationship between a spike in volatility and the S&P 500. I know on an intraday basis they are negatively correlated, as one would expect. Implied volatility goes up when the market goes down. But Darius, my question for you is, which do you think is the chicken and which do you think is the egg? Which is the ultimate cause and which is the effect, if that makes sense?
Yeah, I certainly believe that the volatility signal. So I have a saying, and I'm not sure who the origin of the saying is, but I'm certainly someone much smarter than I am. Volatility is the mathematical expression of fundamental uncertainty or certainty. I.e., if you're in a low volatility state, that means the broader investor consensus has a lot of, they're agreeing to agree on a lot of stuff. When you're in a higher volatility state, i.e., price changes are much higher. Price it's the liquidity isn't there for a price to change hands, for an asset to change hands. That's usually when the fundamental outlook is becoming uncertain. Now, for perspective of the investors who follow my work, there's nothing uncertain about the fundamental outlook. We know the economy is going into what we call deflation from a bottom-up, a macro regime perspective. So again, the market regime is what the asset markets are doing. The macro regime is what the economy is doing. The market regime is usually trying to price in what the economy is doing, 90+% of the time. And so we know we have a lot of conviction in our view that the economy, starting in August or September, is likely to finally enter what we call deflation from a bottom-up macro regime perspective. So we always knew that the markets would have to price that in. Now, when the markets were going to catalyze that shift, was anybody's guess. We could all use the Fed catalyst. We're all reading the Fed tea leaves. They're about as hard to drink as they've ever been, because obviously we have two brand new frameworks to analyze and really try to anticipate and front run Fed policy changes. But ultimately, there's a real big case to be made that the Fed is unlikely to change policy anytime soon. But there's also a big case to be made that, yeah, everyone sort of gets that, but it's really just a matter of inevitability associated with that ultimate policy shift. So, the answer is, I don't know. Well, I don't actually need to know. All I know is the model needs to know. And if I wake up tomorrow morning and something else breaks, I think we'll be in deflation.
Hey, Darius, to that point, I'm curious what you thought about, I guess it was on Friday, consumer confidence number looking like it's rolling over, suggesting we hit a peak earlier, possibly as early as spring of this year. Does that play into, I would assume, your view of this deflationary scenario that we're entering?
Yeah, absolutely. So let me take a step back and make sure I clarify for the viewers. When we say deflation from a bottom-up macro perspective, we're not talking about outright recession. We're not talking about the economy really, kind of piking down. All we're saying is that the trending rate of change of both growth and inflation are likely to be delta negative for an extended period of time. And so, yes, we've already seen this. I mean, year-over-year rate of change data peaked in April. It's been rolling over since. The pick your survey indicator, they broadly peaked in May or June. They've been rolling over since. So it's really just a matter of time before the sequential momentum in the economy from reopening and vaccination dissipated to the point where you're going to start to see broad-based declines in PMIs and things that, kind of investor consensus really anchors on from a growth perspective.
Yeah. So we're about halfway into this show and nobody has said it yet, but coronavirus Delta variant all over Bloomberg today, all over Twitter. What are you guys thinking about this? First, Jack, go to you, and then we'll throw over to Darius.
Sure, Ash. Well, what I noticed is that this is the first time in a while that the stock market, really risk assets globally, have reacted to news of COVID. It hasn't been a very long time, so since 2020, since coordinated risk assets have sold off and bond yields have surged on news of a COVID variant. I might add, Ash, that during the heyday of the absolute peak in cases in the U.S. for January and February, that was a very good time to be in risk assets, in SPACs, tech stocks, growth stocks. Obviously, that rolled over, but it's been totally possible for cases to be absolutely out of control and risk assets to be performing well. But this is an interesting case where you saw that diversion. So, Darius, I want to ask you a question about this. Do you think this is different? And if I can bring it back to volatility, if you had shorted volatility every time it spiked in 2021, that would have been a phenomenal trade. There's some meme stock madness going on in late January, early February. VIX spiked up to high 30s or something. If you had shorted that and faded that spike in volatility, you would have done enormously well. Is this spike in volatility to be faded as well, Darius, or is this if not a March 2020 moment, a moment where a spike in implied volatility is not to be faded, but to be bought because it signals that risk assets will continue to deteriorate?
Yeah, let me, so I'll answer that question in two ways. One, I'm grateful that you brought up the spike in coronavirus case counts and hospitalizations and deaths that we saw in the late last year, early part of this year. And the difference between that and now is the economy is just fundamentally doing something very different. Like you go back to, I don't know if I wore this shirt in my interview with Ed in December, but I certainly wore when I interviewed with them in late May, and it kind of was the same. It was certainly, we're highlighting the same dynamics. Back in December, I said, hey, all the positivity that we're likely to see in risk assets this year, and all the negativity, the negative convexity we're likely to see in the fixed income market is likely to come in the first half of the year, or maybe even spill over into the early part of the third quarter. And the reason for that is because the economy is fundamentally accelerating both inflation and growth. You had fiscal easing at the margins, you had monetary easing, obviously, and you had corporate profit growth accelerating. There have been 10 quarters since 1960 where all 5 of those things have happened. So that's pretty meaningful. In terms of why we're seeing charts that look like they do on a 1 year, trailing 18-month basis. That's why. I mean, so now we're losing a lot of those positive fundamental drivers. So in terms of answering your question, the second part of my answer is, look, if we have a coronavirus induced slowdown now, we just don't have the fundamental momentum in the economy from a growth perspective to really overcome that. And more importantly, it's very unlikely that we get bailed out by fiscal policy like we did in Q1.
Right.
That's a very big difference. It's very unlikely we get incremental fiscal stimulus. Obviously, they're trying to get the budget reconciliation process is ongoing alongside the incremental infrastructure. But who knows what that's going to do? I mean, obviously, if you have a strong view on DC, you're definitely not working here.
So Darius, it does, sort of rhyme though in terms of what we're seeing. We see the obviously the surge in bond prices, yields falling dramatically. I'm looking at the sector analysis right now. It's been financials and energy competing on the day for who would be the worst performer. 1.92 off on financials, 1.86 off on energy. I think it was reversed a little bit earlier. This looks a lot like what we saw during the worst days of the closing down trade.
Yeah, no, you're absolutely right. I mean, deflation is the reason we look at the world from a regime segmentation perspective is because you tend to see low degrees of variance across the time series for various regimes with respect to sector and style factor leadership and laggardship. Like there's a reason high beta tends to not work in deflation. There's a reason defensives and sort of low volatility and high quality names tend to outperform in deflation. People are seeking safety. They're seeking perceived safety, within the asset classes that they must remain invested in, and in asset classes they have a choice to be invested in. And I think that's what's driving this pike in bond yields lower. I mean, you go back to, I believe on June 10th, it was June 10th where the 10-year Treasury yield broke down to bearish VAMs the day after the 30-year Treasury deal yield in our model. And so this is not a news to us in terms of what's happening. I think the acceleration to the downside, the convexity that we're experiencing to the downside is really starting to freak people out in terms of, okay, I have this very reflationary asset allocation on at the bare minimum. I didn't sell enough reflation. And now I'm at this really critical juncture in the economy whereby, something like a Delta variant can actually have much bigger impact than, the sort of second wave surge that we saw in the spring and the winter.
So talking of Delta and data, let's just review for our viewers what's happening right now, what the science is telling us. So the Delta variant, this is B16172, has spread very rapidly in India and in Britain in particular. We know that it's more transmissible. It spreads more easily between people. Delta was 50% more transmissible than Alpha, and Alpha was 50% more transmissible than the original. We were talking about early in the crisis, the R0 number. This is the number of people who are infected by any one given person on average. Obviously, anyone who's familiar with exponential functions knows how quickly raising an exponential function can change the output several steps down the line. R0 was 2.5 on the original. For Delta, it's somewhere between 3.5% to 4%. And data out of the UK shows that kids and adults under 50 are 2.5 times more likely to be infected with Delta than other variants. This is obviously something that is a bit troublesome when we look at those numbers. Obviously, relatively early studies, geographically isolated. But there's also a Scottish study that suggests that Delta is more severe, specifically that the Delta variant causes 2x, 2 times the amount of hospitalization in unvaccinated individuals. And a Chinese study shows that viral load from Delta variant is 1,000 times higher. Now, there's some positive data with vaccination. Let's just run through that really quickly. More than 97% of hospitalizations from Delta variant, 97% are from unvaccinated individuals. In other words, only 3% of the people who have Delta variant and are hospitalized have been fully vaccinated. In the US, 57% of adults are vaccinated. When you look at this vaccine by vaccine, the Pfizer vaccine is 88% effective against symptomatic disease. That's down from 93% effective from an earlier variant. However, the Pfizer vaccine is 96% effective against hospitalization. This is good news. The data suggests that vaccinated individuals have a much, much lower chance of being hospitalized from the Delta variant. I know that's a lot. I know it's a big data dump, but that's what's happening right there on the science. And this is basically what the best estimates that we have from the scientific community tell us. What do you think about that? I know we're not virologists, we're not epidemiologists. We're in this unusual position of reporting on this very serious issue through the context of markets, but some of those numbers look sobering.
Yeah, can I jump in and say one thing? It's very unusual to have a virus mutation become more virulent and also more sort of symptomatic, more deadly, more dangerous. Usually, viruses mutate in a way that allows them to the host patient to survive, so they can spread and stay alive.
Right.
So I'm actually, to me, that's like if that is true, I tend to question that. I'd love to see more studies confirm that. But if that is true, this is going to get way worse. I mean,
Yeah.
I don't want to mince words about that.
This is all data from, if you're interested in the source data, it's data from the Yale Medical School website that has detailed this out. There's a terrific article called Five Things to Know About the Delta Variant. It sounds like a listicle. It's not. It's a very detailed scientific analysis where I got most of the data from this point to review. And then the most sobering fact, and I saw there's something called Delta Plus variant. This is K417N that has additional mutations to the spike protein, which is a concern because the target of the mRNA virus vaccines that are being used against it target the spike protein. So there is some potential risk of breakthrough there. Now, again, this isn't to frighten people. This data is very preliminary, but it is what the scientific research is telling us. Jack, any thoughts on that, how it plays into what we're seeing in markets and how you conceptualize what's going on right now?
Well, Asha, you know a lot more about this than I do. I would simply offer that it really, Raoul's made the point that it's about behavior, right? It's about whether people feel comfortable going on a cruise, whether they feel comfortable going on an airplane, whether they feel comfortable applying for it to a job that has a lot of exposure to that. And that remains to be seen. I think we've been in a phase where we've taken for granted the fact that people would go back to work. They would get on the plane. They would get on the cruise. But if you look at the price action of the cruise liners, the airliners, the energy companies that fuel them today, many of them down 3, 4, as much as 7 or 8%. Clearly, investors are having doubts about that. And if those doubts are correct, obviously you want to own more bonds. I got a question for Darius, which is, let's say that this deflationary world comes. How does that impact your asset allocation? What are you toning down? What are you turning the dial up on, and why?
Yeah, I mean, I think it's going to be a mad dash across the investment universe towards duration in the Treasury market, duration in the JGB market, the Boone market, the Swissy market. It's duration. You want to take up your exposure to those types of exposures. I mean, just in terms of where we are in this super awkward monetary policy cycle, whereby you could actually still see fundamental improvement in the labor market. Now, I would argue put that on pause. If we have a big spike in COVID-19 dynamics associated with Delta variant, negative dynamics, I think the organic improvement in the labor market is likely to be delayed. However, if we don't see that and we still continue to see this organic improvement in the labor market, particularly in the month of September when kids go back to school and that sort of the whole thing gets kicked off, you could see a Fed tighten in months into a deflation market regime and right on the precipice of a bottom-up deflation macro regime. Like, that's extremely negative. And maybe this is what asset markets are really starting to kick the tires on in terms of maybe trying to get out and head for the exits early. And then also in terms of answer your question within the equity market, obviously safety. You want to high grade your portfolio. So in the equity market and the credit markets, that means coming in on the risk curve. Coming higher up in capital structure, higher up in market cap, lower volatility earnings, lower volatility cash flows, things of that nature.
Yeah. To your point earlier, Jack, I remember in those dark days of March and April, where you and I and Ed and Raoul were sorting through this and thinking about what the reaction function is. So you have the actual progress of the virus on the ground, with the battle with medical professionals taking this on, and then you have the perception of what's happening in markets and in the real economy. This is a very complex model to try and figure this all out. Meanwhile, you have things that seem to be happening at multiple speeds. You have, for example, until today, U.S. equity markets rising, but at the same time, you see inflation rising, but at the same time, you see consumer confidence, which is more of a leading rather than coincident indicator, rolling over a bit. This is a very complicated picture to try and understand from a purely markets-based perspective.
Oh yeah, phase transitions are complicated, my friend.
Yeah, definitely. Hey, Ash, one question I want to ask you and Darius is what is the bond market sniffing out, or is it only technical factors that led to a short covering that led to yields being this low? And I actually think we have a clip of Raoul speaking to an investor called Lancaster today that aired today on the Essential Tier, where Raoul asked that to Colin. So let's take a look and see what he says.
Are you of the opinion that growth is not going to be as strong as people are expecting going forwards. How are you thinking that through?
Yeah, I am much in the camp of back to the old normal. We're going to be in the stop and start type of economy. Look, in a period like this year, going into next year, where we have all of this fiscal spending, that which just serves as lighter fluid on the fire, right? But as it's proven that the lighter fluid burns off very quickly. Deficit spending gives a very transitory boost to the economy. So you will have it. It will spike, but then it'll settle back down to the more normal run rate. And I don't see anything that is fundamentally changing that outcome right now.
I think that's what the bond market tells us.
Yeah.
I know great clip to talk about precisely these issues that we're talking about right here today, particularly in relationship to the economy and the bond market. Jack, I understand you have some questions. We've been a little bit long today, again, because of all the information we're trying to get in. We want to get a couple of questions in. Jack, I understand you have a question from the audience.
Yeah, well, this came not from the audience, but from Real Vision's new chief content officer, Barkley, who wants us to ask the following question to Darius, which is, ask Darius, what kind of drop would it take in the equity market to prompt a policy shift from the Fed or the White House?
I mean, I think if you had a 10 to 15% drawdown, and let me start by saying, I think once we transition to deflation from a market regime perspective, it's very likely that we see at least a 16% drawdown. And the reason I say 16% specifically is I'm anchoring on the 2009 analog, where right around this time we started to have the drawdown in risk assets associated with the Fed pulling back on QE1. So it's a very similar setup. We had a real nasty recession. You reopened and reflated for an extended period of time, and then once you start to roll over in the economy, you saw the correction. So 16%, somewhere thereabouts, or maybe even more, depending on the liquidity profile of asset markets currently. But I don't really think it's the equity market that the Fed's concerned about. I think it's the credit market and really the monetary policy transmission channels that are operating through the credit markets. And so the level I would watch there is 500 over in high yield OAS. I'm not sharp on my DV01 statistics right now, but I would imagine that's probably a 10, 12-point decline in high yield credit.
Yeah, Darius, we've actually got a chart up of your great work, which we definitely want to feature your work here from 42 Macro. So let's put this chart up, which is a chart of high yield, the option adjusted spread, as you were mentioning before, and how you are weighing the various probabilities for it. So break down what this chart means and what's it signaling about the future.
Yeah, absolutely. So the first half of the chart just shows our volatility, the evolution of our volatility adjusted momentum signal over the past few years. So obviously, as the chart indicates, it's broken out to neutral. And as I mentioned, just based on the smoothing factor associated with the price action, if we stay above 335 over the next few days, it'll confirm a bullish VAMS breakout, which would mean a bearish VAMS breakdown in the price of credit, in the high price value of credit. That'll also catalyze, if that bullish VAMS breakout would also catalyze a widening of the upper boundary of the probable range, which we're showing in the chart, the second chart, the chart in the lower part. So this is not, I've been talking about this since last, Thursday, July 8th is the first time I said, hey, we're in a very precarious scenario from the perspective of our global macro risk matrix actually having a lot of neutrality that would indicate that the markets themselves are very ripe for regime change. There's a high degree of uncertainty out there that could catalyze regime change. So every day since then, I've been saying, hey, don't run out and buy dips. There's a lot of investors lose their shirts buying dips and not reorienting their risk management soon enough when the market regime transitions. And it works in both ways. Risk works in both ways. A lot of investors who catch the market on the short side keep shorting well after the market starts to bottom and rises. And the same investors who've been bullish, they tend to buy, wait for much longer than they should, heading into a deleterious market regime transition. So understanding where we are in that process gives you the confidence to say, hey, don't buy this too soon. Give it a few days, give it a couple of weeks, because if you go into a market regime transition that's negative, you're going to see the lower boundaries of all those probable ranges just blow out, and that's when you catalyze, or you open up the downside for a big crash.
Yeah. I know we're getting short on time here, but I want to get one question in from one of our viewers. This comes from Hugh Meyer, and it's to you, Darius. Do you still see the potential for a relief rally based on strong corporate earnings for Q2?
Yeah, absolutely. Yes, one of the things I highlight consistently in my work is this relationship between near-term implied volatility and the regime of local volatility over the immediate term, or the trailing immediate term. And that is consistently said, hey, investor consensus is extremely bared up. They're more or less hedged for a crash, right? So if we don't see that crash and realize volatility terms, what you're likely to see is dealers start to unwind those hedges associated with all that put premium. Well, you can also have realized volatility. And so so one of those two things was going to happen. You're going to either melt up or have a meltdown. You weren't going to stay flat, though. And so I think, in terms of what happened today and what could potentially happen this week, and obviously we still need to see incrementally confirming signals. Hey, this could be it. We're moving a lot from here, and it's either to the downside or to the upside. And I would certainly say the probability of earnings season perpetuating a melt up is much lower than it was, even a couple of days ago, just given where the probability of Goldilocks is in our model.
Yeah, I should mention Bitcoin also off about 3% over the last 24 hours, down to 30,733 right now. Ethereum close to 1,800, off about 4% over the last trailing 24 hours, 1819 spot 34. Gentlemen, I know we had a lot to talk about today. I think we did an admirable job of trying to squeeze it all in. Final thoughts, Jack, first to you.
Well, Ash, you know what? Oil traders are saying to people who own Bitcoin and Ethereum, talking about 3-4% drawdown. They're calling those rookie numbers.
My final thought is our probable range model has 11% downside in Bitcoin, around 27,000, 8% upside to about 33,000. So still in this range trade until we break down even further.
And final thoughts, Darius, more broadly on what's happening in markets and the macro economy.
Subscribe, stay tuned, man. We're going to refresh the model in the morning. We could be in deflation tomorrow morning. So if you want the real-time update, check us out at 42 Macro.
Stay tuned. I can't do better than that. Jack, Darius, thanks both for joining us.
Appreciate you, Jazz.
Thanks, Ash. Thanks, Darius.